Welcome back. My name is Mario Pompeo, and I'm a partner in the Cohn Resnick Advisory Group, and I currently lead the CFO advisory practice. As you know, this series of short webcasts was intended to help CFOs plan for the changes to processes, systems, and controls that are likely to occur as a result of the new revenue recognition standard. In this second video of our four-part series, we will discuss putting together a transition plan, understanding the organization's key revenue streams, determining the impact on the company's accounting policies, and determining the treatment of revenue recognition on a going forward basis. Thank you for watching.
Welcome to Cohn Resnick's Accounting Standards Update webcast series focused on ASU number 2014-9, Revenue from Contracts with Customers. Hi, my name is Mario Pompeo, and I lead the CFO advisory practice within Cohn Resnick. I'll be taking you along on our continued journey to implement the new revenue recognition standard. We will begin our discussion today with a high-level recap of our first webcast. As we discussed on the last webcast, the joint effort of the FASB and IASB resulted in aligning U.S. Generally Accepted Accounting Principles, or GAAP, and International Accounting Standards with a few minor differences. The standard's core principle is that the revenue recognition depicts the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods and services. While this sounds pretty straightforward, it is important to recognize the fact that changes can be huge, depending on the industry that your company is involved in, as all prior industry-specific guidance regarding revenue recognition is eliminated. Furthermore, the new standard significantly increases the revenue-related qualitative and quantitative disclosures required in financial reporting. An overview of the new revenue recognition standard. The FASB's guidance affects any entity, public, private, for-profit, that 1. Either enters into contracts with customers to transfer goods or services, or 2. Enters into contracts for the transfer of non-financial assets unless those contracts are within the scope of other standards. For public organizations, the standard is scheduled to become effective for all annual reporting periods beginning after December 15, 2017. For non-public organizations, the standard should be applied to annual reporting periods beginning after December 15, 2018. In the year of adoption, organizations can select from two methods of reporting. The full retrospective method, when assuming a calendar year U.S. public GAAP company, this will mean adoption on January 1, 2018, and the new standard will be applied retrospectively to each prior period's reporting period presented within the cumulative effect of the change recorded in retained earnings as of January 1, 2018. The modified retrospective method will be applied to all existing contracts as of the effective date and to all future contracts. The cumulative effect of initially applying the new standard is recognized in opening retained earnings as of the effective date. Under this transition method, companies only need to consider the effects of applying the standard to contracts that are not completed as of the effective date. In our last webcast, I presented a transition timetable that Cohn Resnick recommends for companies beginning the transition process and highlighted that the time to get started is now. In our last webcast, we covered the concept of identifying a project sponsor and a change management group while also building an implementation task force. We will discuss the next two steps in the following slides. Given that the impact of the standard extends far beyond the technical accounting, the level of preparedness or lack thereof within each company could be a cause for concern, and rightly so. Most companies will see at least some level of change. While most companies will not start applying the new guidance until 2018, preparing for the change will likely require significant effort that could entail a substantial amount of time. Proposed Q4 2016 activities. As calendar year-end companies enter their fourth quarter, they should continue the transition process started in Q3 with the following. 1, ensuring that they begin training and educating key personnel within the organization, and 2, beginning to understand the key revenue streams, accounting policies, and other treatments that will be impacted by the new standard. We'll dive into each of these steps a little bit more with the following slides. Training and education. If management has not already assembled a team that will sponsor and take ownership of the transition process as described on our last webcast, doing so in Q4 is highly recommended. Postponing this any longer could have detrimental effects on an effective implementation plan. Sponsorship of the implementation process should include the CFO and CIO at a minimum. This group will also likely be responsible for ensuring that an effective training and educational program around the new standard can be built and executed. Sources of training guidance. There is also a fair amount of guidance that has been published on this topic, and more is expected throughout the coming year and into 2017. Consider some of the following sources for appropriate training guidance. 1, your external auditors. 2, the SEC. 3, the AICPA and state CPA societies. 4, the FASB and IASB. 5, other professional service organizations and consultants. 6, technology providers with revenue recognition software solutions. And 7, industry-specific journals and publications. Understanding the basics. The revenue recognition model focuses on 5 steps to provide context for what actions every company and organization, regardless of industry, must apply. Those 5 steps are identifying the contract, identifying the separate performance obligations, calculating the total transaction price, allocating the transaction price to the performance obligations, and recognizing the revenue. With regards to the first step, a contract is in the scope of the new standard if all of the following conditions are met. The parties have approved the contract and are committed to performing their respective obligations. Each party's rights regarding the goods or services to be transferred can be identified. The payment terms are identifiable, and it's probable the seller will collect the consideration to which it is entitled, and the arrangement has commercial substance. With respect to the second step, the ASU also states that a seller should identify any performance obligations within a contract and then allocate a portion of the total contract price to each distinct performance obligation. The third step can be challenging, even in fixed price arrangements. This is due to the fact that the new standard requires companies to consider potential discounts, concessions, rights of return, liquidated damages, performance bonuses, and other forms of variable consideration when calculating the transaction price. Finally, the process for allocating the transaction price to the distinct performance obligations is similar to what's done today in many industries and is based on the relative standalone selling price approach. Thus, the company should try to first determine the standalone selling price of each of its performance obligations. Then the company will recognize revenue as it satisfies each of its performance obligations. Understanding the key revenue streams, accounting policies, and treatments. First and foremost, inventory your contracts. Particular attention should be focused on customer contracts with unique terms. This should be done before implementing any new processes or developing new system enhancements. The new standard emphasizes a principles-based approach instead of the detailed rules required in the past. As such, management will be required to exercise more judgment, which is likely to have an impact on future disclosure requirements. In other words, more disclosures to explain those judgment calls. Furthermore, new processes and controls may be required to document those judgments and to ensure that they are applied consistently throughout the organization. Finally, depending on the significance of the accounting policy and/or gaps, consider the need to involve others in the process. Potential significant accounting and reporting changes. In applying the 5-step revenue recognition model previously presented, there are a variety of significant accounting and reporting changes for companies to consider. The following are some of those changes that are likely to be more significant than others. Multiple element arrangements. In multiple element arrangements, where a company sells service contracts and warranties with products, the warranty-related provisions may represent either an element of the contract from which deferral of revenue is required or an item for which a warranty service accrual is required, generating differences as to how delivery of the service is evidenced and proven. Estimated selling price. In cases where the selling price of a good or service is variable or uncertain, the residual approach is allowed in certain circumstances in which the company may estimate the selling price by reference to the total transaction price less the sum of the observable standalone selling prices of other goods and/or services promised in the contracts. Time value of money. Note, there is a practical expedient which allows entities to disregard the time value of money for short-term contracts. However, long-term contracts require consideration of the time value of money in determining the transaction price when and if the contract includes a significant financing component. With respect to the timing of revenue recognition, the new rules allow for revenue recognition to occur as each performance obligation is satisfied over time or as of a point in time. Also, some companies used to recognizing revenue upon shipment of a product or delivery of a service may find that they must recognize it over the life of the service that is implied in an identified performance obligation. With respect to construction-type contracts, contract costs not eligible for capitalization, in other words, they are treated as inventory or direct fulfillment costs, should be expensed as incurred. New accounting may require separating elements within the contracts and recognizing them with different margins at different times than in the past. Disclosures. Disclosures will need to be enhanced as the standard includes a number of disclosure requirements that are intended to enable users of financial statements to understand the amount, timing, and judgments related to revenue recognition and cash flows. So what's next? If you're not already working on the transition, get started now. With little more than a year left before calendar year-end, public companies are required to adopt this new standard. There is still time to take appropriate action. At the firm, we do not believe that any further deferrals of the revenue recognition standard implementation dates will occur. If you have not done so, please review our first webcast presentation on the new revenue recognition standard and continue to follow along with our remaining webcast presentations, and we will offer more practical guidance on how to implement the steps on the transition timeline. In our next installment, we will focus on the activities that should start taking place in early 2017 and carry on throughout the year. Thank you for joining the webcast today, and I look forward to seeing you next time.